Welcome, everybody. Let's see if we can get going here. We're going to start with a short video. This is a client video, and if I can get it to play here, let's just see if we can get it to go.
I'm Gentian Shero. I'm the co-founder and CEO of Shero Commerce. Founded the company back in 2010, and we've been in business for 12 years now.
I am Beth Shero, and I am the COO of Shero Commerce. We build e-commerce websites globally for customers, and we focus on strategy and providing value to help them grow long-term. So e-commerce is where you have products. You may be a retailer or just have a product or service that you want to provide, and you want to sell it digitally online to the world.
First couple of years, the main obstacles that we had with the business was having a business plan, having a go-to-market plan, having a niche target market or focus for what we were trying to do. Strategy Leaders was recommended to me from someone I knew at the Regional Chamber of Commerce. Our first interaction was very positive, very consultative and productive. The first goal was to put an evaluation together. Beyond that, we set like a 1, 3 and 5 year plan, and we put metrics in place as to like how we could achieve the goals in those plans.
So strategy leaders helped us navigate that by actually providing us data and facts to help us make decisions versus it being a gut instinct.
They are one of the most accessible teams that I have worked with. They respond to email really fast, text messaging, phone calls, Zoom calls, like they are there, and it is an amazing experience.
Strategy Leaders not only is our business partner and has helped us grow, but we also have worked with them as a partner as well. And what I mean by that is that we've developed their website and provided consultation around how they can grow their online business through SEO, improving their online presence, and making it easy for them to update and manage their website.
I would recommend established businesses that have a clear vision and idea of where they want to go, but they have reached their peak and they see that, hey, they cannot be an accountant, they cannot be a salesperson, they cannot be a marketing guru and run operations day to day. So Strategy Leaders is the answer to solving all those issues, or to identify them and then point you in the right direction on how to solve them.
So I hope you enjoyed that piece. We very much enjoy and appreciate our relationship with Shero Commerce. They are a great client. I think they've worked very hard with us, and we're delighted to be able to feature them and share a little bit of information about them. Great company. Encourage you all to go take a look at them. And with that, let's get started today. We're going to start with some introductions. Dahlia is going to put up a poll question here, and we're going to ask you to tell us a little bit about who you are. Are you a business owner? Do you work for a privately held business? Maybe you're an advisor to privately held businesses or have some other function. We just have a little curiosity as to where you're coming from. And while you're working to fill in that poll question, I'm going to go to the next slide and talk a little bit about who we are as Strategy Leaders. The company started based on foundation research that was done at Columbia University on how to build a successful 21st century economy. We have been in business for over 25 years. You see here a picture of our executive team. And this team, along with all of our other employees, have become specialists at working on the growth and development of privately held owner-operated businesses. And that includes helping owners and their companies transition from the stage of entrepreneur, where we all start our businesses and where something like 95 to 98% of all companies end, to stage 2, where the companies are still privately held and owner operated, but now they become business builders. The business is run for the purpose of growth, profit, stability, and predictability. We do work in a wide variety of industries all over the United States and some international, and we offer them a broad set of services, which I will get into in just a second. And I would certainly encourage everyone who's here today, if you have any questions or you'd like to have a free consultation, just put it in the chat window, let us know. We'd love to explore possibilities with you. In terms of ways that we do help our clients, as I said, we teach entrepreneurs to be business builders. That includes creating plans, working with the owners and their executive or management teams, coaching them to achieve higher levels of performance. We do a tremendous amount of family-owned business. I like to say that virtually every privately held business, one way or another, is a family-owned business. We do valuations for businesses. This is something we got into because our clients needed and wanted the support, and it's now used for either exit or acquisition. I'm really pleased to say that we found a solution that is both inexpensive to use and very quick to deploy. And we do provide companies, in addition, with advice on how to sell their business, how to get ready to sell, how to actually get through the exit, as well as how to buy if you're looking to grow the business through acquisition. We do transition planning and implementation. So post-acquisition or post-exit, how does the future owner take over and run the business successfully? We provide companies with support to get dashboards up and running, KPIs established, key performance indicators. We do a lot of what-if modeling. And then not last, but certainly not least, we also do budgeting for businesses, which is what we're going to talk about today. So with that, Dahlia, why don't you just bring up the results of the poll and let's take a look at who we have here. And it looks to me like we are mostly business owners and a few advisors and a little bit of people who classify themselves as others. So welcome everyone to the meeting, and I hope you find what you're looking for today. We are going to go very quickly through today's agenda, so it would not be out of the realm for you to have additional questions at the end. Please submit your questions in the chat box. We will get to them when we get done. And we also, as I said, are more than happy to take your calls and speak with you more specifically. In terms of today's agenda, we're going to take a quick look at why you should care about budgeting. Then we're going to get started with laying out a process, talking about a budget cycle, giving you some rules to live by. We're going to take a quick look at a quick budget tool, give you some practical suggestions to think about as you're working on budgeting. We do have a dashboard tool to show you very quickly, something that we think can help any company that's trying to stay on track with their budget. And then we're going to wrap up with some case studies. So real world client experiences and the advice that they have for all of us here in the audience today. In terms of why care, I would say that the biggest reason is that no budget can lead to blind spots and very ugly surprises. You see here on the screen a list of top reasons for business failure, and most of these either can be solved with or at least improved in terms of outcomes by having a budget. And I would like to point out that, in my opinion, a well-planned small business budget is one way to protect your business from not only having difficulty, but actually from ultimately crashing when too many things go wrong. In terms of what's been your experience with budgeting, we've got another poll question for you. So Dahlia, if you would bring that up, and we're going to ask you to fill that out. And we'd like to know your experience. So it might be that you have one and feel good about it, or you have one but want some advice, or you haven't had time to get to one, or you don't know where to start, or something else. So if you would quickly fill that out, and as you fill that out, I would really like to say that the budgeting process is a way that you can see issues and opportunities. You can play it out on paper before you live it in reality. If you don't like the outcomes, you can change it before it happens. And it gives you a way to set the guardrails and use them to then later on keep your business on track. So with that, Dahlia, let's see if we have enough responses yet. Is everybody filled in? And yep, it sure does look like it. So a lot of you do have budget experience, and some of you haven't had the time to get to it yet, but are either thinking about it or trying to figure out how to get started. Hopefully today's webinar will help you with that. And for those of you that do have one and feel good about it, I congratulate you heartily on taking on the task. So in terms of looking at budgeting, let's start with the process. You want to start with the process of setting goals and then assessing those goals. Do you like the outcome? Use it as a way to build some best and worst case scenarios, circulate the information, get feedback, get everyone's input. Once you have set up a budget, then you can put it into action where you get to test it out against reality, make periodic adjustments, and make notes on what you're learning so you can apply those as you go forward and get smarter each year or each period as you engage with your budgeting process. I will recommend that you start with historicals and use that as a way to evaluate what's going on in the business, figure out what you like about the business, what's working, what are some things that you need to fix, whether it's low income months or places where cost of goods sold may spike or gross profit may dip, or maybe your overhead goes off or you don't have enough cash on hand. Start looking for all of those squeaky wheels in the business, and then that's going to be something you're going to be able to work through in the budgeting process. And by all means, always think about using the budgeting process to engage your team in terms of gathering input and then ultimately gathering their buy-in. So in terms of thinking about budgeting, we want to set up a process that you implement over time. The period from January to September is really your input period. You collect your spending requests, get suggestions from people on where to make cuts, build a list of new development projects that people would like to consider. And from March to June, you want to decide who's going to participate in the budgeting process. And in June, you want to start to get those people who are going to participate more training on finance so they are ready to engage and actually capable of contributing easily and effectively. You also, starting in June, want to do some guesstimates on how the year is going to turn out. So if you can figure out how this year is going to turn out, then you can use that as a launch pad for forecasting the next year. You do want to then forecast what you would like to see for a growth rate from year to year. We'll talk about what make those reasonable growth rates in a minute. And then you start to play out some what if scenarios. So when it comes to playing out what if scenarios, we have a cute little tool here for you. And hold on one second, and I'm going to flip to it. There we go. This is a real quick model where you can lay out a whole bunch of scenarios of what's going to happen to revenue, cost of goods sold, overhead, net income. So this model is for the P&L with down here some balance sheet effects. So let's just say we've got a $2 million company. And let's say their cost of goods sold is 60%. And let's say that they have about 700, oops, sorry, wrong place, about 700,000 in overhead. And that's in the current year. That's, I think the current year is going to turn out, which will give them about 100,000 this year. And then in terms of next year's plan, we've laid out a whole bunch of scenarios to consider, and you can go in here and change these. So you might say, you know what, instead of 3%, I want to boost that to a 5% growth in revenue year over year. Or I want to see what would happen if I could reduce my cost of goods sold by 2 percentage points rather than by 1. And what I want you to get out of this is you can very quickly, with very little information loaded in here, start playing what if. And when you get down to the bottom line, it has some very interesting outcomes. Clearly, we probably don't want to play out scenario 2, but then a lot of times we play with net income and forget to think about the balance sheet effects, growth investments, paying off any term loans, paying down the credit line, adding money to reserves, and then also what we think we're going to have to pay in taxes, which at the moment I have zeroed out just to simplify the model, but you can put in any tax rate you want in here. And once you start playing that out, then you start saying, you know what, I probably don't want to play with scenario 1 either. Scenario 2 looks interesting. It's a little bit more net income than I had before, but I like these further out scenarios. So let's see what that's all about. And so if this sounds interesting to you and looks like it could be an interesting tool for you, then please put a note in the chat and we will be happy to get you a copy of that. And now let's go back to our webinar. And we got ourselves all the way up through June and starting to look at forecasts for the next year. By October, you want to do some analysis and firm up some of your guesstimates. So at this point, you want to export a full year, 12-month cycle, take Q4 from the last year plus Qs 1, 2, and 3 this year, lay them out, see how they fluctuate month by month, quarter by quarter, and then mock up the next year and do that both by month as well as for the full year. Add in your wish lists. What do you want to do in terms of projects? Check on the results and then distribute your first draft and start getting feedback on it. By November, then this is the refinement months. Gather suggestions, evaluate risk and opportunity, look at the ROI that you're looking to get on new projects, look at the overall income, and make sure that it's going to be worth all of the time and effort that everyone's going to put in to make that net income work. Come December, you want to finalize your budget, confirm that everybody's bought into it, and then get it loaded into the accounting system so that you're ready to go for the next year. Now, here's some rules that we suggest you consider as you work on developing your budget. Grow revenue year over year in the 10 to 15% year over year range. Not the easiest thing to do. Certainly the Fortune 500 struggles to do it, as do most privately held small businesses. Once you learn how to do that, it's one of the real tricks and keys to keeping the business profitable and increasing your net income year after year. We also suggest that you work on a model to reduce your year over year cost of goods sold percentage by 1 to 2% a year, at least until you get at or slightly above the norm for what your industry is doing. What you will find is that as the percent reduces, as long as your revenue is growing, the dollars will increase. And that gives you money to grow personnel, materials as revenue grows, even as you're throwing more money to the bottom line. In terms of forecasting revenue, my first piece of advice is get an assistant who's really strong in Excel to work as your partner on this project and get them involved with doing all of the modeling so that you can step back and look at what's going on. Start by listing all of your income sources, review the last 12 months, which categories are up, which are down, meet with your sales and your marketing team. What do they think is possible? What can marketing do to support sales? And start setting goals. Do that not only by year and by quarter, but all the way down to by month, by product or business line, and by customer or customer category. Identify any places where you need to change the goals. So for example, if you have a couple of down months in terms of revenue, you want to focus on how to pull those months up so you have a more stable platform to work with in terms of revenue. And that's where you want to focus a lot of your planning. Fix or replace the least profitable clients or work. So you got to figure out who those are. And then reduce any clients that represent over 8% of revenue so that you can reduce the risk to the business with any disgruntled client. Make sure that you don't record deposits as revenue until you do the work or hit your contract milestones. When it comes to cost of goods sold, you want to forecast cost of goods sold as a percent of revenue and then let the dollars grow as revenue grows. You want to establish cost of goods sold sub percentages for things like labor, materials, inventory, waste rate, and then forecast each of those categories independently. Overhead, you want to have basically function as stably as possible month over month. Typically, you'll have things like rent, insurance, and telephone, as well as salaries and benefits and marketing and sales costs in there. Do take the time to predict any spikes and try and limit your year-over-year increase for overhead to about 3%, if you can. And marketing wise, that's the one place where I'd break that rule and say, go for a slightly bigger growth rate. 5% would not be out of the norm. Again, look at your industry and look at both revenue and gross profit metrics on that. If you do see that sales are falling, I would suggest that you boost your marketing and sales expenditures faster than the 5% rate. And if sales are spiking, then you might be able to hold the percentage constant or reduce it. And whatever you do, put your commissions into cost of goods sold. That's the only part of your marketing and sales expense usually that does not belong in overhead. When it comes to understanding payroll, you actually have two types of payroll: cost of goods sold and overhead. Your cost of goods sold payroll is variable. Your overhead payroll is more fixed. So cost of goods sold payroll would be people that you let go when things get tough, and you have to boost up when you get more successful in sales and you're growing your revenue line. Overhead would be people like the owners of the business, the people who are working in marketing and sales, and your managers. As you work on payroll, also establish a ratio of benefits to wages and then allocate those benefits to cost of goods sold and overhead. Set a revenue per FTE ratio. We recommend somewhere for most companies between 110,000 and 175,000, with about 150,000 being a real sweet spot. Make sure you do predict variations. So if you're paying your payroll every 2 weeks or twice a month, then some months, if you're paying every 2 weeks, some months you'll have 3 payrolls, some months you'll have 2 payrolls. If you're paying weekly, then some months you'll have 4 payrolls, some months you'll have 5. Make sure that you do distinguish that as you lay out your budget so you can see where the variations are, because it will impact your cash flow. And then when it comes to payroll increases, make sure that you're using job bands, use research sources. Glassdoor and Indeed have a lot of information that you can use, but look ahead and think about what kind of increases are you likely to give out next year. Certainly, a lot of companies have raised salaries this year, and the expectation may be that that could happen again next year. Finally, in terms of net income, I want to remind everyone that substantial net income is a sign of a healthy, thriving income. Or thriving company. And to make sure that when you're planning, I suggest you work backwards from net income. As an owner, be demanding. This is the kind of profit I want to see. How do you make it work? And then as the business grows, you should expect that more net income dollars will drop, or more dollars will drop to the net income line. Other things to think about: customers. Identify your top profit customers, both existing and future, and define their upcoming needs. So this is, again, research, turning to your sales and marketing people. And then also decide on the number of new customers that you need to hit plan and the growth that you need from your existing customers. When it comes to suppliers, build up a backup supplier list. I think a lot of us have worked on that this year as we've gone through supply chain issues. Be sure to plan out any price increases and make sure that you have an emergency fund if there are any price spikes that come along. And do be prepared for the unexpected. Fill in gaps in the plan with acquisitions and promotions. I think that's something that most business owners don't think enough about, but it's a great way to acquire personnel, acquire revenue, acquire know-how, and it's a great way to make a leap forward for the business. When it comes to managing cash flow, set up a monthly ship and invoice minimum. So ship is the delivery to the clients, and invoice is how you charge the clients. Understand that any gaps that there are between invoices and collecting money. Reduce any production bottlenecks, because that will shorten the time frame between when you have to lay out money to produce and when you actually can invoice and then collect. Schedule out any material ordering so it doesn't happen in big bulks. Keep the inventory low, but as we all learned this year or last year, not too low. Assign someone to keep an eye on office expenses and get control of your credit card statements. Now, I'd like to take a minute and look at an example of how to control what's going on. So building the budget is one piece. Once you've got your budget, now you've got to gain control of what's going on. So we're going to flip over here, and I'm going to turn this over to Christina, who's going to talk to us a little bit about a dashboard that we have. And some of you who may have been on other webinars may have seen examples of this. And if you're looking for more information on this, we'd be happy to reach out to you after the webinar. Christina, turn it over to you. It's all yours.
Thank you, Andy. As Andy mentioned, I'm going to be presenting a quick snapshot of our financial dashboard. That is a neat tool to help you with budgeting, watching trends, and outliers very carefully. When we're looking at this first graph, we're looking at the cumulative 2022 actual versus 2021. Here we're tracking the primary drivers of the P&L. So we're looking at the revenue, which is the green, gross profit is the blue, overhead is the pinkish red, and the net income is the yellow. So we're comparing how the client is doing this year versus last year. The importance of that is the visualization and being able to quickly spot what is up and what is down, whether there are any problems or trends to watch out for on a monthly basis. And here we can see that the revenue and the net income for the first 2 quarters are significantly up versus 2021. In fact, this client has already accomplished in 6 months what they did for the entire year of 2021. This is an industry where there's been a lot of pent-up demand, and they're very much benefiting from that right now. If you want to scroll down to the next graph, Andy, we are looking at revenue by quarter. Thank you. We're looking at revenue by quarter here. In this graph, we're analyzing the revenue by quarters, like I said, and here we can really make good recommendations for our clients. We actually really recommend clients also to look at trends on a quarterly basis. We can see how it's trending comparing to the past, which helps you with the budgeting and forecasting much more accurately. So we were looking at if it's down, where did it drop? As you can see here, there was a pattern with COVID in the first quarter of 2020. And clearly you can see how they're coming out of the COVID. So they've had a nice, slow and steady progress coming out. And now they're actually starting to produce some of the best quarters in the company's history, which is very impressive. In the next slide, we're looking at year-over-year net income. And as Andy suggested earlier, she's suggesting working backwards with the owners in terms of thinking of their budget and their net income goals. So we're setting a goal here, and that's the red trend line pictured in the graph. And we're playing the what if game that Andy talked about. And we have to figure out how much revenue must we produce in order to cover the cost of goods sold and the overhead expenses. The other colored horizontal lines are averages comparing the same period year to year. So this client started out 2022 very strong and has on average a net income a month of $122,000, which is about $59,000 above the average goal line. So for this client, it's time to go back and discuss. So can we keep up this net income level over Q3 and Q4? And should we adjust our forecast accordingly? You can see the gray bar for June is extremely high. The question is, can we keep this trend? We may or may not be able to. So that's what we're going to discuss according to the budget. So we're looking at overhead expenses. When we're budgeting, it's very important to keep a close eye on the expenses. So we suggest categorizing overhead expenses into general and administrative, marketing and sales, and salaries and benefits. Those are the horizontal lines you see going across. In this way, we can pick out trends much easier. We can see how a business has high months and low months. And one of the things an owner should work on and want to work on the upcoming budget is how to make this more consistent, which will help cash flow from a cash flow point of view. And so we want to eliminate these peaks and valleys that we see here. So we can see this client, for example, in December month tends to pay out bonuses and prepay some expenses from a tax point of view. Another way to look at expenses is looking at it stacked. It's really what does the owner like to look at? What's an easier visual for them? We can clearly again see that December 21 was an outlier with the majority of the expenses sitting in the G&A. Here we have again, for a budgeting purpose, the red lines going across. They're showing the average for the period year to year. So again, we keep comparing the same period from year to year. It gives us a more accurate picture. And we can see, despite having much higher revenue in 2022, this client's done a really good job of controlling expenses during this growth. Not easy to do. So we're moving on to the balance sheet. see a nice progression of cash on hand in this example. In 2019, they had pretty strong revenue, but very little focus and discipline to control these expenses and putting money aside. They've increased the average cash on hand by about $800,000 in a matter of 3 years. So with discipline and patience, things will work out well if you plan well. On the next slide, we're looking at cash on hand versus expenses. So this result of their discipline we see reflected in this graph, where we compare cash on hand to expense averages. So we're measuring how long the business can stay afloat if revenue for some reason would drop off, just like we saw during the COVID for many companies. So this is a great example of how someone has done a really good job of keeping a lid on their expenses, both through COVID and coming out of COVID, prioritizing building up cash. The horizontal lines that you see going across measures 1 to 12 months of average overhead expenses. And we see this company now is in a safe territory of built up cash of about 18 months worth of overhead expenses. Going on to the next slide, we start looking at banking ratios. Here we're looking at current assets to current liabilities. Want to make sure that we're always bankable above the dotted line. So that's definitely a ratio we recommend looking at. The next slide is also a banking ratio. In this graph, you want to be below the blue dotted line. You want to know the actual debt you can tap into. If you're hovering over the last green bar, Andy, you can see that this company is very well positioned and can raise somewhere around 5.7 million if they need to. In the final graph, we would like to show you trends of assets, liabilities, and equity. So the blue line represents total equity. This typically drops during tax planning, but this company has made a decision to do business planning. They want to have something sellable and lower their debt and building up cash. So you can see this steady progress, which we also saw in the earlier graphs, but now you can see it in relationship to the debt that they have. They have a lot of cash, low debt, but it's taking them a long time to get there. This is what has been building up their equity. So these last couple of graphs, in our experience, business owners rarely get to or fully comprehend the how or the why, or why the way they work they do. And they don't get the sale value they want because the sale value sits right here on these graphs. It doesn't necessarily sit in the net income or the profitability on the P&L. With that, sending it back to Andy.
Thank you very much, Christina. And as I said earlier, if you have any interest in learning more about our dashboard product, please put a note in the chat window and we'll be happy to talk to you more about it. It does have a mobile component to it. We think that's incredibly important in today's world where the business owner is out and about so much and doesn't necessarily want to take the time to have to get back to the office to see how things are going, so they can pull it right up on their mobile. Now we're going to go into the last section of our webinar and just take a look at some case studies. This first one is all about it's what you don't know that will get you. And in this situation, the client experienced rapid growth and that led to unexpected challenges. Things happened externally that weren't in their plan. People weren't prepared and didn't know how to respond. And the lessons learned, so the advice from the client to our audience today is to use budgeting in order to identify gaps in the organization, kick off learning early, what people need to know in order to succeed in the upcoming years, have contingency plans ready and be prepared to take action on them, use your budget to build in accountability, and then challenge your team to bring the business in on plan. With the next case study, what we're looking at here is 82% of small businesses lack sufficient reserves. And in this case, they had clients with 90-day terms, which in some cases meant 120 days of cash outlay. They got a lot of orders in, things looked really promising. And then as that orders started to flow through the system, that growth led to the cash drying up in the company. And as a result, they wasted time chasing customers for payments, and then they had to cut back material buying, which led to production delays, which led to a drop in invoicing. And this client's advice and what they learned from this experience is to use the budget to predict cash flow gaps, establish a cash and credit cushion, so very much what Christina was talking about in terms of cash on hand, Don't extend credit over 30 to 45 days. And if you do extend any credit up to 45 days, charge for financing costs. They recommend anything over 15 days. Make sure that the credit line is enough to cover your payment gaps, and then understand your banking ratios so that you know what the bank will and won't do with you if you do get into any crunches. Third case study is about credit problems. In this case, the client got a loan to fund growth and development, but they didn't plan out exactly how they were going to use every dime of the loan, and they had no return on investment goals. As a result, they ended up misspending or underutilizing the credit. They paid off some old bills, which had no return in terms of boosting future outcomes, and they ended up handing out some bonuses that ultimately they couldn't afford. And their advice was use a loan budget when you're getting ready to do a loan. Only spend on things that will get you a return. So profitable marketing and sales efforts, things that will help you better manage and cash flow and reduce expenditures related to managing cash flow. And also think about seriously about using some of that money to do acquisitions. Make sure that you have an ROI on the borrowed money against the cost of the loan. So how are you going to make money on that loan, and then pay off the loan early if you can, or you term out your credit line, which will then make you more bankable in downline years. Next case study is about being ready when opportunity comes knocking. And in this case, the client didn't have the funds to invest when the right opportunity presented itself, which was heartbreaking, and they couldn't take advantage of growth breakthrough potential that presented itself. Their advice is plan it out, get profitable, stay profitable. So by plan it out, they meant plan the whole business out. Include in the budget money to pay down debt and money to add to reserves. Stop overspending at year end to save on taxes. Build a slush fund for opportunities. Bank with a small regional bank and get their advice and get them to really understand your business. Grow without overburdening the business with loans. So know what's the right amount of loans, not too small, not too big. And then finally, our fifth case study is about informed decision making. Owners and managers in this company met when they were available to discuss the business, but not everyone showed up all the time, and the meetings weren't regular. They lacked notes and fact-based reporting. There was too much guessing going on, and the loudest voices in the room tended to predominate. And their advice was to use budgeting as a managerial decision-making and analysis tool, circulate reports before meetings, expect people to prepare before they come to the meeting, and document monthly what's going on in the business, what are the successes, what are the mistakes or the weaknesses, and what is agreed on in terms of what's going to happen next. Assign go forward accountability, so have a next steps list, who's going to do what, by when, and demand results. So continue to refer to that next steps list, continue to use the budget, and ask people to bring it in on plan. And with that, we're going to go to one last poll question. So we're going to divert for just a second, and then I'm going to take your questions. And we would really like to know your opinion on any additional webinars. So Dahlia, if you can bring up that last poll question right now, it'd be great. What topics would you like to see from us in the future? Here are some suggestions: leadership, finance, human resources and employees, marketing, business operations, sales topics. Check off any that you'd like to hear about. Also, feel free to put any suggestions in the chat window, and Dahlia will pick them up, and we are going to use this for our future planning. And with that in mind, I am going to then, oops, I'm going to flip over here. Thank you for attending. And I would encourage all of you to make use of this budgeting tool, this budgeting webinar, to set your company up on a pathway to success. And if you want to have a conversation, we think everything in terms of making progress starts with a conversation. We'd love to talk with you. And Dahlia, do you want to bring up the poll suggestions? Let's just see what everybody's thinking about here. Okay, so it looks like business operations is a big winner. And the rest of marketing topics was also a big one. I think that's a lot of what people think about as they come into the back half of the year, is that we are, really figuring out how are we going to deliver well, and then how are we going to hit our goals for the rest of the year and gear up for next year. So with that in mind, we're going to flip over as a reminder to, sorry. As a reminder to all of you, what we work on with our clients is growth, profit, stability, predictability, peace of mind. Call us for a free consultation. Try out our budgeting tool. Let us know if you'd like to get a copy of that. And with that, I'm going to back up here. And Dahlia, do you want to bring up any questions that you have from the audience?
Yes, so I do have a question, and it's about the software that we shared earlier, and it's, is it a good idea to use software to make and customize your budget, and what are the pros of using software for that kind of thing?
Okay, so the tool that we were showing you is actually our proprietary dashboard system. It's very expensive. We've spent probably 20 years building the methodology behind it and a lot of money programming it so that people can use it easily. I don't necessarily suggest that somebody build their own dashboard because it can be very expensive, and the cost to use an existing tool on the market, whether you want to talk to us or anybody else that does have a tool out there, I think you'll find that the payoff is pretty good in terms of just using an existing tool. In terms of budgeting and preparing a budget, I personally am just a big fan of Excel. I think it's a good tool to both analyze what's happened up to now and then match that up against projections and do a little bit of what if planning.
Okay, great. I have another question, and it is, what do you have any advice on what to do if you exceed your budget?
So I thought Christina's example was a great one on the dashboard, where the client had actually blown way through the previous year and actually has blown through their budget for their projections for what they would do for revenue and for net income. And you should be looking at that probably quarterly and thinking about, do we need to make any adjustments? I don't like adjusting the budget in the first few months of the year because I think that January, February, March, there is just too much variability going on, and you need the year to settle down. The first quarter is often the lowest quarter for any business. So I would be careful about playing out my year just based on how the first quarter went. Certainly by the midpoint of the year, you need to be having conversations with operations, with sales, with marketing. How are things going? What are their projections for what's going to happen through the back half of the year? And how might that impact what you're forecasting at this point in time based on reality as well as projections?
Great. We have another question from Tiffany, and it's, what grants are available for small businesses, and how do you find those resources?
So most grants are available for not-for-profits. So now you're going to have to decide on the structure of your business. If you're privately held and you're not a not-for-profit, but you're an S corp or a limited partnership or a DBA, then you're going to have much less in the way of grant opportunities. And from time to time, you'll see an announcement that one of the big guys is doing a special promotion with grant money available, but I think you'll find that those have just a mass rush to get in the door and very little available. I think you need to, in terms of getting started with the business, you need to think carefully about how you're going to make a profit right from the get-go. And if you don't have enough money to make a profit, then I would be very careful about how long you go in the paradigm of not making money. I will tell you, most small businesses that operate under $500,000 really struggle. They struggle to survive. They struggle to overcome hurdles and challenges that crop up in their path. And you want to make sure that you have a paradigm where you can grow revenue. Now, one of the places that I think most business owners don't go enough is doing acquisitions. So acquiring an existing business in order to make a growth leap is a great way to go. The SBA will provide funding, but you have to go through a local bank. They're called SBA lenders. So they will start the paperwork and then they will go to the SBA for the backing. And that is a great way to expand the business. Yes, you will take on debt in order to do that, but when you take the debt on, you also are taking on a much bigger net income portfolio potentially, and that's what you're going to use to pay down the debt.
Awesome. I have another question. It's
Okay.
how often should you review your budget?
I would recommend that you review that budget monthly, not just yourself as an owner, but with the entire management team, and have a lengthy discussion. A couple of hours is not unusual. What worked, what didn't work, what's each area of the business finding that is being effective, what are they seeing as challenges, how can you help each area of the business, and what adjustments need to be made in order to bring the business in on plan. Have someone in the room who is taking notes, recording next steps, putting dates and to-dos and names together so that they can send that out as a follow-up and then use that again next month to follow up on the suggestions and action items that people had brought forward.
Okay, great. And I have one last question.
Okay.
It's about debt. What is an ideal time frame for paying off debt?
Oh, that's an interesting one. So most companies have two kinds of debt. They have a credit line and they have term loans. Term loans are fixed payments over a period of time. The term loan cannot be called by the bank as long as you make your payments. A credit line is based usually on things like your accounts receivable and cash on hand, and is used by the bank to provide you with funding to get through cash flow shortages. And the credit line can be reduced and demanded by the bank at any point in time. They are usually meant to be paid off within 1 year, although I would tell you most small businesses don't bother to do that, and treat their credit line more like a term loan until the bank ends up calling it. I would suggest that you have a mix of both, and at the same time that you take a very balanced approach to paying down debt and building up reserves. And so you look at your net income and figure out what it's going to take to put $1 to cash and $1 to debt. So as you're paying off $1 in principal, in terms of paying off your debt, you also are reserving $1 to put into cash reserves. Now, why do I say that? So many business owners work really hard to pay down their credit line, and then they go to the bank and they say, we want to renew the credit line, and the bank says, you don't have any cash sitting around, your accounts receivable don't look very strong, so we're not renewing the credit line, and then you're really screwed. So if you have cash on hand, it means a great deal to the bank. It shows the bank that you are working to keep the business solvent and have a cash cushion that you can rely on, which certainly we all found to be very important and valuable as we came through COVID. And so paying down the debt, I would say, is a bit of a planning process with the bank. How much do you have to pay on the term loans? That's a requirement. How much do you need to put away in reserves? And then what can you do to chip away at the credit line? The other thing that I do recommend to companies is that if they get stalled on the credit line and can't pay it off in whole pieces, is to think about terming out bits and pieces of it. And again, we'd be happy to work with you on a game plan to do that. Usually we find that there's about 3, maybe 4 steps. And then at that point, you're out of the credit line, you paid down your debt, and you're home free with cash in the bank.
Great, thank you, Andi. I think that's all the questions that we have for today.
Okay, well, that's great. I want to thank everybody for coming today. I want to thank you for your time and your interest. I hope this was helpful, and please let us know how we can help you. Thank you very much.